23rd of March 2023, Thursday, MAO with Cal. Once again, guys, the current problem is 5 times larger than 2008-2009 crisis. Do you know that? Well, apparently yesterday, the Federal Reserve have increased interest rate by 25 basis points. And the way they say is like they are dovish and hawkish at the same time. Dovish basically means that they want an easy monetary policy. Hawkish, they want to tighten up. So how can you be like having laxing of it and while tightening at the same time? This is what is happening right now. And to me, it's simply kicking the can down the alley again and hope for the best. But we have seen it before. They failed terribly. They tell you that the inflation was transitory, but what happened? We all know we are paying a lot more money now for our Chaipan. So let's go into details for today, and let me tell you what is going to happen and why we need to be very careful. But once again, guys, I have this spin the wheel lunch with Cal this coming Saturday. All right, today's already Thursday, so only left today and tomorrow to leave your comment. Okay, basically it's all right. We will be selecting 4 people. Okay, confirm 4 people to join us for this feast on next Wednesday. All right, so the thing is this place itself is actually at Paragon Shopping Center. Once again, I'm not doing any advertising for them. It's just that because we're going there, so we're just going to just by right just doing this. Okay, and this restaurant is a 4.5 star rating, 780 reviews. Okay, all right. Yesterday, wow, thank you guys. You guys are very, very nice. You guys are actually updating in, putting in all the questions and what do you call comment in it, and I replied to you guys, every one of them. Thank you so much, guys. This is very appreciative. Now, of course, if you actually come in and just only put a comment, but there's no relevance to the video, then I won't be able to give you the chance to go for the lunch with me. So it has to be something related to the video. All right, so like this guy Tom, you put that trading the boys, okay, but this is nothing to be related to the video, so I didn't give you a love shape. So if only those people who have a love shape and a thumbs up at the same time, then you will be able to get a chance to spin the wheel with me. All right, so guys, put something related to it. Okay, thank you very much. Now, yesterday, someone commented, Cal, last few days, your video getting longer and longer from 28 minutes to 29 minutes. And yesterday was crazy, 34 minutes. Guys, come on. I give you great content, guys. Look at my content itself. You go find any content in the market like this. Every video takes me easily 4 to 6 hours to tabulate, research, compile, extract, what do you call, arrange. Even arranging how to deliver to you yourself is not so easy, right? So that is why it takes a bit more time. But if you think that this is like a 30 minutes is too much for you, so I mean, seriously, you can't get any compilation in 30 minutes. And even today, the content is incredible, loads of video to go through with you, so it may cross the 30 minutes again. So if you think that this is not for you, you can just skip it. If you think it's good, let's continue, right? Disclaimer apply as usual, and thank you, Ames, for the kind sponsorship. Now, let's recap what happened last night. Wow, the Dow Jones dropped 530 points, NASDAQ down by 174, S&P dropped below 4,000 mark again. Now, yesterday, I was just telling you guys, there's a good chance that the S&P 500 will come off, right? I already said that via a chart pattern, and of course, spot on. So people make money, I'm happy for you. Now, yesterday, practically, other than the video AMD because of the AI, all right, the rest of the all the counters is some majority or down. Even Tesla was down by 3%. Now, the one that caught my attention was Wells Fargo. It was down by 3.33%. Now, to me, right, Wells Fargo is a very, very precarious position right now. I believe that if anything goes worse, things can get in trouble. And Charles Schwab also came down 5% yesterday. All these give me a bit of in my skin. I feel that you guys should be very careful. I've been saying this word careful for a long time. I hope that you actually understand where I'm coming from. So the thing is this, Chairman Powell says that the financial conditions seem to have tightened. Okay, so it's because what we see in the market right now with the interest rate rising, and then this is the earnings not coming in. So obviously it's all right. Okay, definitely it will have some significant macroeconomic effect, definitely for sure. So yes, indeed. So the Fed increased by 25 basis points, widely expected, and they are saying that they will be watching it closer. So on the bullish side, the Federal Reserve, the projections says that there should be only one more rate hike based on the dot plot. But Powell in the news conference said that the inflation fight is still far from over. So one side itself is unanimous, 25 basis point. But when Chairman Powell was speaking to the journalists, he said that, well, we are still very far away. Maybe we need to rate hike more. So become dovish and this hawkish at the same time. So now the thing is this, people are looking at 5.125 for the Federal Reserve Fed fund rate, and likely will stay there for a while. Now, I don't think so. I repeat myself again. I believe we'll see 6%. I'm going to write it down for you guys. I still believe that we'll see 6% because the thing is this. I mean, I already tell you guys that it doesn't make sense that the current inflation now is at about 6% at 6.6%, right? And the Fed fund rate is about 5% right now. So if you want to reduce inflation down to 2%, then what do you do with the interest rate here? You have to go higher. So at least, in my opinion, you must go at least 6%, right? This is the CPI figure, and this is the Fed fund rate, yeah? Correct. So think about this. It is impossible. It's really incredible. So to me, there will be more rate hike coming in. So I believe that this figure will eventually go to 6%. I know that by saying this again, I'm not going to make anybody happier, but you have to understand the relevance of this. So in fact itself, right, the Dow Jones was initially quite happy. The Dow Jones actually went up first during the day, up by 200 points. It was here up by 200 points. Then after that, what happened? Janet Yellen came in and said something very, very interesting, something that is correct, but it's like, okay, I thought you were saying that everything's okay, right? And then the market just danked from there. So which means that the market dropped by 700 points from the highest point. So think about this. Why would the market drop 700 points? Because they are very concerned right now. And why the market go up, right? It's very clear. It's a pump and dump. So Jerome Powell came in the start of the Federal Reserve meeting and so by addressing the bank sector. Let's look at what he had to say for this time, right? Let's take a look. Okay, let me just bring it into you now. Jerome Powell, let's go. Open, yeah. Okay, here we go.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal.
So you hear for himself, he knows the problem and he are trying their best not to repeat what happened previously, but I'm so sorry, I don't think so. I think that they know the problem, but they cannot prevent it, and this is going to get worse. And because they have to bring down inflation back down to the 2% that they have been repeating, all right? So to me, it's all right. This is not going to help, and things will get scarier. And of course, we all know that the Federal Reserve have increased interest rate for the 9th straight meeting. So I'm going to skip this video because I know that you guys know what's going on, so I'm going to skip this one. And then the thing is this. Federal Reserve say already, right? Chairman Powell, don't expect any rate cut this year. That is more important. The other thing is I cannot understand why Wall Street keep on asking for rate cut when they know that it's impossible with the inflation going on right now. How could that be happening? So it really don't make sense. Let's listen to him, the man himself.
Basically, participants expect relatively slow growth, gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking for purposes of our monetary policy tool. We're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt.
Can you see that again? He repeat that there's no way there'll be a rate cut. You can do other things like flattening credit, right? This is what he said just now. And that's was something that I mentioned yesterday, that Federal Reserve can do all this. So my point is, if they tell the bank not to lend any more money or stop giving too much loans, basically it's a credit crunch. So you may not really increase interest rate, but there's many, many ways to skin the cat. All right. So that's the reason why I felt that this is going to be a kick here itself. All right. So of course, Jerome Powell pretty clear. He said that the rate hike will continue. It will not stop. Although he did say that maybe one more time, but come on, man. We all know that this is not really possible. I think I'll show you this particular video instead. All right. Well, if needed. Yeah. Let's see it. Let's hear. Okay. I mean, hopefully I get the video up. Okay. Advertisement here.
Cha-ching. Style like mine deserves to be shared. That's why I sell.
Okay.
Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end?
No, absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on the labor market, on inflation, and we're going to be watching to see what that is, and we'll also be watching at what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
All right. So you heard it for himself. This is the guy telling you that what may happen. Okay.
Do you feel, though, that if
sorry about that. Okay, so the thing is this, Jerome Powell is very clear that there will be more rate hikes, there will be no rate cuts, and they'll do other things if they really need to. So all these things is pretty hawkish, right? So what happened? Why the market suddenly go up, right? I mean, is it going to go up? No, the market came down. That's why, because he was so hawkish in his view. So that's the reason why there are people saying that it was the Fed that bring the market down. It is. If one of the things that is risky right now is definitely stock market. And that's why now Tom Lee, he is one of the bull in the market, right? Says that this banking crisis could fuel more panic if the Federal Reserve tighten further. Let's listen to what he has to say so that you have a strike or balance between the bull and the bear. Let's go. Tom Lee, where are you? Here we go, Tom.
And this is quite the headline, that a 25 basis point hike today is both bullish and bearish, and that stocks, they might rally anyway. Tom, quite the opinion here. You're known as a big-time bull here. So explain this. No matter which way we go with the Fed decision today, you're seeing a rally?
Well, Frank, I'd say that the probabilities are higher for a rally. And I think Steve made an important point, which is that even though the stock market's been kind of resilient, there's been a huge tightening of financial conditions in the credit world. You know, the best way to see it is the MOVE index, which is basically the bond VIX, is that it's still at 160. I mean, that's like a 50 VIX. And we know there was almost a black swan-like failure of many hedge funds last week in credit. And so the Fed, I think, has to be cognizant that if they do something that further tightens financial conditions, and it means that stocks actually fall, this banking crisis could fuel more panic. So I think that investors know this. They've been cautiously positioned, which is a point we've made. I think that the fact that bond VIX has pulled its financial conditions are super tight there. So I think whatever Fed action they do is not about how much they raise, but it's their desire for financial conditions to not get worse. And I think that's why stocks could actually rally today post FOMC decision.
So see, Tom Lee says that the market will rally, but you can see that what happened to the stock market, the market came down. So you see the difference there. Different camps have different views, some bull, some bear. So end of the day, the final thing is this, your P&L is most important. Yep. Okay, so we have bull, we have bear. So let's see what Michael Burry had to say versus what I said. Now, Michael Burry on 13th of March says that, okay, 2000, 2008, 2023 is always the same. People full of hubris, okay, hubris, yeah, okay, and greed take stupid risk and fail. Money is then printed because it works so well. I totally agree. And in fact itself, right, in my video, I wrote down there that we're likely to see the same thing happening in year 2000, 2008, and 2023, right? But of course, I added one more, 1990. Because if you look back, right, it seemed to be the same. Every 10 years, we repeat this. So 1990, 2000, 2008, all about 10 years, right? So if you add another 10 years in, that will be 2018, which is exactly what happened in 2018, where the Federal Reserve tried to reduce the do QT, and then the market just shake. So of course, we decided because of the pandemic, we have to increase by $4 trillion extra to 5 trillion. And then the whole thing kickstart again upwards, right? But now the thing is this, the whole thing has concaved so fast. We're back down to 2018 period. And now we are even worse time off. So that's why I like Michael Burry. But trust me, guys, it's a pain, really, real pain. Why? Because one moment in the morning, I see Michael Burry's article. The next moment, he deleted. This guy is really insane. I mean, I understand why he want to delete, but this guy really has his own character. So this is Michael Burry official Twitter. 1.4 million people actually follow him, but he don't follow anyone. Pretty cool, right? The thing is this, fortunately, right, there are some people who really follow him and basically extract away a lot, or whenever he posts, they extract it up so that when he delete it, okay, at least we get to see it. So thank you so much for this person. Okay. There's one article recently he actually want to sound out. Now he said this. There's an article out saying that I was suggesting USB. Okay, it's a company, yeah, and this Comerica were next. This is not true. One chart, a couple of data points, such cannot encapsulate all of a bank is. Okay, so basically, what was the chart again? This one here itself. Now this chart basically shows the unrealized losses versus the CETI capital and the deposit of the banks. So apparently now on the line, there's two key points, which USB, yeah, indeed, and CFA. All right. So the thing is this. People are now speculating maybe this Michael Burry is trying to warn people about them. Well, the thing is, we don't think so. But in fact, it's we look at the share price, we cannot deny that this company, right, is down from $70 to $44 now, down basically $30 from the high, which is nearly 50%. And the other company is US Bank, we call USB, right? The share was trading about $48 at one stage. Now it's at $34, down about 27%. So all these actually speaks for itself, right? That they are affected. So all I can say is this. Okay, whether Michael Burry did it on purpose or just basically trying to cool down or tone down, I'm going to watch the US banks very closely. But there's one particular counter that I'm very, very concerned. And this counter is Capital One, COF, okay? Now, Capital One credit default swap are surging. Look at it. It's surging, guys. This is really high level. Look at the surge, right? The last time we saw this was back in 2020, whereby we have the pandemic. So the thing is this right now, the Capital One has more available for sales, securities, and equity, putting itself in a similar position to Silvergate and Credit Suisse. Okay, similar, not exactly, but it's good enough. So that's the reason why I'm pretty concerned right now with this company. And if Capital One go down, right, I believe that things will just blow up again. So this is why I say, guys, we are not out of the woods yet. Very surprising that for Federal Reserve to think that we are right now. Just cannot see that point. So in the S&P 500, yesterday, I already told you guys about it, right? I drawn for you this chart. I said that we are near the market top for this round. And of course, some people, they buy it. They say, Kelvin, down, good job there. But you can see that some people say no, because initially it went up first. Okay, guys, a burst up of the trend line is a very technical thing. We all know that a lot of stops that triggered, but you look at the way it came back down. Now, the only thing is this. It came back down. If you notice carefully, it stopped perfectly at the moving average MA 200. So it's very clear that it's very heavy manipulation right here, right now. So if the market actually loses the moving average at 200-day moving average, I believe we'll see the market coming back down. And this time round, I think we will see 3,800 traded. Okay. Now we missed the 3,800 recently. All right. So I believe that it will come down this time. So traders, watch out for today. Today or tomorrow is very critical for the S&P 500, okay? All right, so what caused the selling first, right? Because of Yellen. Yellen basically came in and says that do not consider a blanket insurance for all the bank deposit. Wow, my God, okay? So when this statement came in, it basically shook everybody's confidence because we have a rate hike right now, which is 25 basis points, still within control. But suddenly right now, you have something like this, that Yellen says, then of course, if those companies like what you saw earlier, right, those banks, smaller banks, if Capital One go down, what if this Comerica go down, what if US Bank go down, then basically this is going to shake the entire market. So to me, that's the main reason why. And of course, Jim Cramer actually came in and said, yes, it was Yellen comment that rattled the market, not the Fed rate hike. So I cannot believe, I'm trying to like follow, agree with him, not every time. So all I can say is this, Yellen says that the government is not going to bail out everyone, okay, especially the shareholders, bondholders. So all these speak for itself, all right? So the new dot plot right now is pretty interesting. Now they have increased it higher, you can see very clearly, and they're looking at least 5% for the entire 2023. No one in the Fed committee is looking at any rate cut. That is very important for the new dot plot, okay? So if you believe in this, you have to follow through, guys. Now in 2024, that's interesting. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 of them is looking at the number to go down. So they are expecting rate cut next year. So think about this. If let's say there'll be a rate cut next year, that means that the stock market will likely be recovery. So if the market will recover, then what must happen first? So that's the reason why I believe that if this is like a plot chart right here, this is June, right? Or July period. I strongly believe that the stock market now, which is March now, right? This is March. The stock market will come down to June, July period. Then it will slowly recover. And then after that, by August, we will have our recession as official. Then slowly, they'll start to cut interest rates slowly, or they may start to pause it a bit. Then you have slow recovery. And of course, by then itself, right, we'll need a lot of help from the Federal Reserve. They'll cut interest rate, and then maybe by then the stock market will rally up once again. So what do you think? I think that is likely the game plan, if you ask me. Right? So let's see what we have right now on the economic projection from the Federal Reserve. We can see that they already lowered down. So the thing is this, they lowered down their 2023 GDP forecast to 0.4, okay? This is very clear cut, but interestingly, they also increases their PCE inflation figure to 3.3 and a core PCE inflation to 3.6, but they do expect it to be lower for next year onwards, right? And expect GDP to increase by next year too. So all this information tell us that the Federal Reserve knows that they are not able to bring down interest rate unless they keep on hiking. So that's the reason why hiking on interest rate is definitely the thing for the next two meetings, in my opinion. Now they're looking at one more hike next month. The next one, no, I think there'll be 2 more rate hikes, and that should bring the market down, because when the rate hike came on increasing, that means that the cost to the bondholders, which is the banks are holding it now, will be much higher, and they will have to pay the price. So you look at it right now, right? You can see very clearly if you put the S&P 500 versus the SPDR, S&P Regional Banking ETF, you can see that the ETF is down by 20%, but the S&P 500 is hardly budging. So again, seemingly someone is holding the market while allowing this sector to go down. But of course, conversely true, if this sector is recover, wow, the S&P 500 will go through the roof, right? Exactly. So that's the reason why I felt that right, we are not out of the woods yet. There should be one more wave of selling coming in, and then the thing itself, right, then the market will pull back. But once you have this invisible hand in the market trying to save the day, it will still be a good bottoming out signal for you to buy in June, July period. So of course, we have some experts saying now that it's an economist saying that the recession will hit everywhere all at once. And of course, she gave a number. Let's listen to what she has to say. Okay, let's go. Here we go.
Last year was sort of a taste of things to come. And I think we could easily see a 30% decline in the market. You know, earnings estimates continue to be pie in the sky. The forecast for this year, I think, is down 2%, which that would be the first time in history we've ever escaped with that minor decrease in earnings. And the amazing thing, Maria, and I had to check this like 5 times, but last Friday, when they did the update of analysts' earnings forecast, it reflected an increase in the estimate for the financial sector, which they took up from somewhere around 8% to 9.5% for this year. I don't know what is going on there, but there are clearly areas where expectations for earnings growth are so far out of touch with the likely reality. So this market.
I totally agree. I mean, yesterday I won in my video, right? Apparently the analysts are actually marking up the earnings will be better by end of the year itself. I cannot understand how they get this number. I mean, it's incredible, it's silly, and I don't think it makes sense at all. And I think it's pretty wrong. If you pass this information to people, the investors, come on, man, to get hit, right? Think about this. All right. So, sorry, there's some there's some error here. Give me a moment. Let me just solve this. Okay, quick one. Okay, so the thing is now we are back to 2008, 2009 again, right? Now, why do I say that? Now, let me explain to you now with some charts. And just give me a moment. I think I just missed out the PowerPoint slide for this particular one. Okay, let me just do this quick one here. Okay, moment. Apology on this. Too many slides, guys. Not easy to do so much thing at the same time, yeah? Okay, why do I say that? Because now, right, we are just basically 0.25 away from the highest peak of the interest rate back in 2008, 2009, okay? So we are just so near to it. So if history basically repeats or rhyme, then we are back to the same point again. That's the first thing, right? Second of all, it's all right. This is how it happened yesterday. The market basically accepted the rate hike. But when Yellen came in and said that, no, we're not going to take care, we can't be covering everybody, so that shakes the confidence of everyone. And isn't that something that you know that will happen next, right? So the thing that really made me very, very concerned is because in 2008, we were actually, the Fed fund rate was so, the Fed balance sheet was at basically $1 trillion. All right. And then when it increases it itself, right, the maximum event was $2 trillion and it managed to save the day. But the thing is right now, we are now back to $8 trillion and likely more to go to print. So if you imagine now from here itself is 2 trillion and here is like almost 10 trillion in a way. So like 5 times. That's the reason, that's a scary part. So if we are having a 5 times bigger balance sheet, right? Do you think that what will happen if the market really cracks? So again and again, my voice is simple. I don't expect a market crash like what happened in 1987, but I believe that the market to drop by another 10% is very, very possible. So that is the reason why I don't think we need to be too complacent right now and buy shares. I think we still got some time. We should just go slow. What do you think, guys? Let me know in the comment box yourself. This is Cal signing off. Have a great day. I'll see you on the technical side. Bye-bye.